federal government shut down Wednesday after lawmakers failed to pass a budget or short-term funding bill. The Congressional Budget Office estimates about 750,000 federal employees will be furloughed for each day the government remains closed. Here with more on what this means for your money is Yahoo Finance senior columnist Carrie Hannon. So, Carrie, what does a shutdown mean for those hundreds of thousands of furloughed workers?
Yeah, that's correct, Allie. I mean, there are those that are furloughed, but there are also hundreds of thousands more who need to continue to report to work without pay. These would be people in safety and those areas like air traffic controllers and so forth. Now, the thing is, when the shutdown ends, federal government workers will all receive their back pay. But if you're a contractor for the government, you're not guaranteed back pay.
What about Social Security? Do benefits still go out during a government shutdown? And will a shutdown affect whether or not those payments actually get made?
Yeah, that's a great question. What the Social Security Administration says is, yes, indeed, checks will continue to go out. They do not expect any slowdown in service. They expect them going to be on time. And we have to go with that. So I think that anyone who's worried about that, they should be okay at this point.
And how could a protracted shutdown affect the cost of living adjustment for Social Security? Because even though people say this could get resolved in a matter of a few days, we have seen instances in the past where it's taken months for the two sides to reach a deal.
Yeah, this is tricky, Allie, because the cost of living adjustment, the COLA, is usually announced in mid-October, and it should have been in October 15th, ideally this year, because it's based on the inflation numbers, the CPI, from July, August, and September. And so now, since we will not have the September number to put the average of those 3 months together, that's how they determine what the cost of living adjustment will be per check, Social Security checks, starting in January. And they announce that, and people have time to prepare for what that adjustment's going to be. So this can it's very possible this is going to delay what that announcement will be, what they're going to determine the adjustment will be for next year. The current amount that they're talking about, the estimate I've heard is 2.7% increase, which is slightly better than it was this year. But that doesn't, we're not sure if they don't have a hard number there. Maybe they'll go with the number from just July and August, but we just simply don't know yet. Last time this happened in 2013, there was roughly a 2-week period where it was sort of an unknown period. But then once that everything started rolling again, they got that CPI number, they announced what the COLA would be for January.
Government shutdown continues. Investors will not be seeing September jobs data from the BLS tomorrow morning, but there is still plenty to discuss around the economic outlook, the state of labor market, and what could be next for the Fed. Joining me now to discuss is Adam Johnson. He's portfolio manager for the Bullseye American Ingenuity Fund, and Shelley Antonevich, chief economist at the Investment Company Institute. Thank you both for stopping by on this Thursday. So Shelley, let's just start with you and your view on the state of play for the U.S. economy, knowing we're not going to get those jobs numbers tomorrow, but how you're thinking about maybe the private market data that we saw over the last few days, and if this lack of data, in your view, is going to change anything for the Fed with less than 4 weeks to go for that next meeting.
Well, I think that the private data that's been put out through ADP, and then there was additional data today released by the Chicago Fed and another third party on hirings and layoffs. And I think that what they're showing is consistent. It's a slowing labor market. Hiring is way down. While, I know that the Gallagher data showed that layoffs were at an all-time high, that really didn't come through in the Chicago Fed data. And we are seeing in the employment data that's been published to date by BLS that it is hiring, but very slow hiring, very muted hiring. So it is a weak labor market, certainly not where the Fed wants it to be. And I think that at the end of October, if they've not seen those BLS numbers by then, they will continue on the easing path for a 25 basis point cut. And in fact, the market, if you look at the market, they're already pricing in another 25 basis point cut in December.
Yeah, I'm not sure that Powell and company were anticipating a government shutdown, but that no risk-free language that he kind of unveiled, I think, makes that decision in October pretty easy. As you mentioned, markets pretty much on board with that 97%. I think it's the last odds I saw on that. Adam, I wanted to talk with you about something that Jared mentioned, which was what's happening in the bond market. And really, I would get the calmness, maybe we could say, or the way that bonds have taken these developments in stride, and what that says to you about the setup here on a macro level. And we'll talk about some of the other areas of the market you like later on.
Yeah, well, message of the market. I mean, clearly the bond market is not worried right now about risk in general, and there are a couple of ways we can measure that. Number one, just look at where yields are in general. They are way down from where they have been. They're not in the danger zone. The 30-year is well below 5%, and that's the one that I think most of the pros watch, because the Fed can control the near term, the 2-year, and to a certain extent the 10-year, but they can't control the 30, and if the 30 stays under 5, it tells me that the bond traders and the bond market in general is not worried about inflation long term. That's a good thing. The other thing that I watch, the other indicator, is the spread between treasuries, the risk-free rate, and corporate bonds. And incredibly, that bond spread right now is somewhere around 75, 80 basis points. I mean, the all-time low was 72. So two very important indicators, messages from the bond market, if you will, that risk is not a concern. Does that mean we're smiling past the graveyard? No, I don't think it does, because as I think you know, Miles, I'm very bullish right now. I'm fully invested. I think there is a lot more to like than to fear. So I think actually the bond market's got it right.
And then, Shelley, thinking about, we did start the fourth quarter. It's time to talk about 2026, where you see things headed in the economy next year. I think there's some sense that maybe we would begin to start to see the idea that there was a lull in late Q2, maybe Q3 this year, but that there's grounds to make the case for reacceleration next year. How do you see things as you start to tee up the outlook for first half of 26 and a year from now?
Well, for me, the outlook for 2026 looks a bit clouded right now. I mean, we do have the government shutdown. Everybody is expecting it to be short-lived. But I think the wild card there is how much spending will be done by the workers and the potential for sort of permanent layoffs or permanent firings. So you would have all of these people coming into the labor force unexpectedly and looking for jobs, and they are not going to be spending. And much of the growth in GDP that we saw last year was consumer spending. But even without sort of that wild card of, potentially thousands of federal workers looking for new jobs in the new year, what we saw is a weakening in September of consumers. Consumers are getting more worried, and particularly there's a bifurcation of consumers. Consumers with low stock holdings, they're not very optimistic about the future. They're not optimistic about their financial sort of situation a year from now. They're going to likely cut back on their discretionary spending. Families with, relatively high stock holdings, they're feeling more confident. So I think that their continued spending is definitely going to depend upon what happens in the stock market over the next year.
Now, Adam, we hear Shelley talking about the outlook for consumers. I'm curious how you're looking at what we've seen from the tech sector in terms of that massive investment into the U.S. economy, those announcements. That, of course, feeds into the GDP calculation, less so than spending, but it's meaningful at this point.
Well, and isn't it interesting that as we've had 2 months now of soft GDP numbers, actually negative, we also got a GDP print of 3.7%. That is very strong. So the economy is moving forward, even as there's some weakness in the jobs numbers. Yeah, that is very curious. There are 2 stimulus programs happening right now, thank goodness, that account for why, in part, I am so bullish. Number one, we have had 17 trillion of foreign direct investment deals, if you will, announced since Inauguration Day. For perspective, 17 trillion, that's half of US GDP. Mm-hmm. It's also 4 times the total stimulus of COVID. And that money, though not all coming in at once, will be coming in over the next, call it 2 years. So that's one stimulus program that's happening in the background, and I think is driving that GDP growth, or at least starting to. And the other is the AI tech spending by the hyperscalers, the Googles, Amazons, Apples of the world. $320 billion this year. rising to $420 billion next year. I mean, that's like a whole other separate stimulus program. So yes, there could be some softness at the low end for, as Shelley's mentioning, some of these federal workers who may be displaced.
Yeah.
But that is so dwarfed by the stimulus that's coming in at the top with the FDI, $17 trillion, and AI spending $420 billion next year.
All right, we'll leave it there. Adam and Shelley, thanks so much for your time.
Government data just went dark, but money never sleeps, as they say. In today's Stocks in Translation, we're going to show you the playbook that keeps traders moving when the big jobs and inflation reports are on ice. And here are the major holes that we've got to fill. The BLS delivers not only the big monthly jobs report, but also inflation measures like consumer price and also producer price inflation. Meanwhile, the Census Bureau's retail sales, durable goods, and new home sales and factory orders, they're also on hold. Add to that the BEA, which calculates GDP, personal income and spending, as well as the PCE inflation gauge that the Fed likes. But there are more. The weekly jobless claims report is also going dark. Now, let's walk the proxies. On the jobs front, monthly private payrolls from ADP, it's a big one. In fact, we just talked to RSM chief economist Joe Bruce Willis on the Stocks in Translation podcast, and he said,
the Fed's got a much more difficult degree of landing because, believe it or not, the Fed gets a weekly update of the ADP estimate.
oh, interesting.
They do. Most people don't understand that. So the Fed's not flying blind when it comes to the labor market.
There's also high-frequency shift data from Homebase, job postings from Indeed, and layoff color from Challenger. Then for prices and inflation, the Institute for Supply Management, ISM, and S&P Global both publish prices paid numbers, which help give direction. And online price gauges like the MIT Harvard Billion Prices Project, rents from Zillow, gas prices from GasBuddy, and e-commerce data from Adobe, together they help build a picture of price pressure. But Joe tells us that the Fed still has its work cut out on the prices front.
Inflation's a little bit more difficult. You know, they're probably going to be talking to the MIT Harvard Billion Prices Project. And to get an idea of what's going on, there's a whole host of alternative data that we're all going to be talking about for the next number of years.
Exactly. And when it comes to spending and demand, we've got credit card spend from B of A and JP Morgan Chase, Redbook weekly same-store sales, and open table seatings. Then for manufacturing activity, there are the purchasing manager indices from ISM and S&P Global. And for shipping and logistics, we have the Cass Freight Index, reports from the Port of LA, Long Beach, not to mention TSA checkpoints. These are your week-to-week thermometers. But we also have market-based data that you can find through the tickers on the Yahoo Finance site, as well as the app. And for big indices, you can measure the S&P 500, the SOX, which is the Philly Semiconductor Index, the Dow Transports, as well as the NASDAQ Bank Index. Then for interest rates, we've got them across the yield curve, from the 13-week T-bill rate to the 30-year T-bond yield. And with volatility historically rising this time of year anyway, keep an eye on the VIX for stocks, the ICE B of A Move Index for bonds, plus OVX and GVX to measure oil and gold volatility, respectively. Finally, there are hundreds of new ETFs, and many of them measure wonky market stats. LQD and HYG measure investment grade and high yield corporate credit, for instance. And I like to take the price of IEF and divide it by IGIB as a measure of credit stress. When it goes up, that means investors are preferring the relative safety of US Treasuries over corporate bonds. So now you've got the tools, let's avoid the traps. First, focus on direction, not one-offs, especially with higher frequency releases on narrower data sets. It takes 3 prints minimum to make a trend. Then try to cross-check at least 2 independent sources. Are they saying the same thing or are they disagreeing? And always understand the methodology. Wonky things like sample bias and revisions can bite you. And finally, track the release times. Volatility will cluster around these drops, and the lack of big reports means that market seasonality itself will be affected short term. Bottom line, a data blackout doesn't mean you're blind, but until Uncle Sam turns on the lights again, we might have to work a little smarter. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.